In this video, we'll see what an option is. You'll learn what a call and a put are and the risks associated with these assets. Let's start with call options. In this graph, we see the stock price on the x-axis. That's the underlying on which we buy the option. For example, we can buy a call option on Amazon. The price of an option always depends on the price of a certain underlying. If I invest in a call with a strike price of 40, then these are the profits or losses depending on where the stock price goes. Our initial loss is given by the fact that we are buying the call. That's a cost for us. We can also see how the maximum amount we can lose is the cost of the call, so the risk is limited. Then, if the stock surpasses the strike price, reaching the point that divides the green and the red lines, we gain an amount that is equal to the cost of the call. So, in that point, a little below 50, we reach break-even. From that point on, we start gaining profits. Technically, a call option gives the owner the right, not the obligation, to buy the underlying at the strike price, K. That's the reason why we make money if the stock price reaches 60. We can exercise the option, so we can buy that stock at $40 and sell it on the market at 60. That's our margin. Now let's see the case of a put option. The graph of the profits is the following. The strike price is at 35, and here we have a profit if the price of the underlying goes down. Between 20 and 30 we have break-even. Down from there it's all profit. A put option gives the owner the right, not the obligation, to sell the underlying at the strike price, K. If the stock reaches 10 and I have a put with a strike price of 35, I can sell the stock at 35 while on the market it sells for 10. So right there's an interesting profit. These are graphs that you might have seen. They are exactly like the ones we've just seen, but without considering the cost. The payoff function for the call is the max between ST minus K and 0. For the put, we have the max between K minus ST and 0. These are the cases in which we buy an option. What happens if I want to write an option? That is the technical term for saying selling, shorting an option. For example, if we write a call, we can expect this graph. As we're selling the call, we immediately gain what the other counterparty paid for it. Remember that the position of power between the two counterparties is reversed if we compare it to the previous cases. What I mean is that when possessing a call, you have the right to exercise it when you prefer. But when you sell a call, it's the other person that has the right to exercise it. You have the obligation to honor what they want. Obviously, it works like this, otherwise there would be no exchanges for options on the market. The risks of selling are much higher than when buying, as you can see from the red line. Before, the red line was flat, meaning the max we could lose was the price we paid for the option. But now the potential loss is theoretically unlimited, as there is not a limit on how much a stock can grow. We know that there are limits in reality, but they could also be much higher than what you expected, so we should not underestimate this risk. For the short put, the same thing applies. We still profit at the beginning from the selling of the option. Then, if the stock goes under the strike price, we lose money. The payoff functions are these. In particular, for the short call, the payoff is the minimum between K minus ST and 0. For the short put, it's the minimum between ST minus K and 0. So to summarize what we've seen till here, in the long options, meaning when you buy them, you pay a premium to enter and you're exposed to limited risk. You cannot lose more money than what you've paid for the option. While for the short options, you receive a premium to enter. You immediately gain money from the selling, but you're exposed to unlimited risk. For the short call, the risk is unlimited. For the short put, the maximum loss is capped at the strike price multiplied by 100 minus the credit received. Here we have a cap on risk, as a stock cannot have a negative price, and we multiply the strike by 100 because an option usually controls 100 shares. But don't think that the short put is safer than the short call because it has a loss that has a limit that is capped. If a stock reaches 0 and you have a short put, you're down an enormous amount of money. Something you should remember is before shorting options, you must know the strategies that are used to hedge these very high risks, but I will make another video for that. I hope you liked this video and that you found it useful.